Welcome once again to another series of how KRA operates. This is part 4. Today we're going to be looking at key laws that you as a business owner or someone who wants to understand the landscape of business and tax should know. And these key laws include the Tax Procedures Act, the Income Tax Act, the Value Added Tax Act, and the Companies Act. Now, let me start with one of the most detailed one, which is Tax Procedures Act. Tax Procedures Act explains the rule of engagement between you and KRA. So it shows, first of all, number 1, registration and your tax account, how you should register. And basically, if you have wrong registration, there will be compliance gaps or you'll have unnecessary penalties. So as a business grows, your tax profile evolves. Number 2, it talks about record keeping. And one of the key things it mentions is records are the foundation of tax defense. Without records, you cannot be able to. Without good records, then you do not have a good defense whenever it comes to tax disputes. And so it gives you a threshold of minimum 5 years. Number 3, we have the filing obligations. Returns are your official declaration to KRA. KRA, it is expected of you to return, to file your returns. Number 4 is self-assessment responsibility. It is your responsibility to calculate your own taxes accurately. You are supposed to calculate so that you compare and reconcile with KRA. Number 5, audit and information requests. KRA can request documents and explanation at any time. And that is the act that gives them that mandate. That KRA can review your bank activity, your sales patterns, your VAT claims, your expenses support, and it can request for further explanation on them. Number 6, there's something called the assessments and amendments. KRA may issue default assessments, additional assessments, amended assessments. A default assessment is a calculation made by KRA when someone has failed to file their tax returns. How does that come about? KRA calculates from third-party information and it gives you a mandatory notification that you're supposed to pay that tax. So however, when you it can be reviewed once you file your taxes and you have defense, remember, for your filing. Additional assessments is an official adjustment of the tax. It is the official adjustments by KRA based on your returns after doing some findings from audits stemming from maybe underdeclared income or findings from reviewing your activities. Remember, this assessment is not final, it can be challenged, and if you have the correct defense, remember the burden of proof is on the taxpayer. If you have supporting defense, then it can be reviewed as well. Amended assessments just comes from when you review your tax returns. Maybe you made an error and therefore KRA can, based on the support you have given, can allow an assessment, amended assessment on the returns that you had issued. It can also be instigated by the commissioner if they find reasons that you underdeclared something. We have penalties and interests. These are incurred due to late filing, late payments, incorrect returns. Another thing that the Tax Procedures Act talks about is enforcement powers. When there is tax debt, it is enforceable by law. And here we see things like agency notices, bank agency notices. Agency notices is where KRA can put a legal directive to subject third parties such as banks to direct payments to them directly if you have tax debts. Also, it can block your tax compliance certificate. This is something many people are experiencing, especially if you have unpaid tax debts. So this is the enforcement powers that are given to KRA through the Tax Procedures Act. Another thing is it also gives you rights and procedures of objections and appeals. You should object within statutory timelines, provide supporting documents, and if you want, you can escalate your issue to the tax appeal tribunal if necessary. Remember, the burden of proof is on the taxpayer. Now, tax compliance certificates helps you in tendering, bank financing, investors confidence, and Tax Procedures Act guides all these things as we have discussed. The other laws that of interest include income tax, which just explains how income, it explains what income is taxable, what expenses can be deducted, and which ones cannot. Also explains things like capital allowances, which are long-term assets and typically be deducted over time through capital allowances instead of being expensed at once. Another one is a value-added tax. It explains how VAT is collected, remitted, and the threshold, and also the validity of tax invoices and ITIMs, and monthly VAT returns. Companies Act is simply showing how a company is run, describing a company, which is a separate legal person with its own money, records, and obligations. And this is one thing business owners must understand: the separation of a company and its owners, the shareholders, the definition of shareholders and directors, where board resolutions are needed, annual returns, and how to issue dividends. So basically, these are the 4 laws that one must try to understand. Companies Act, which talks about creating the legal business structure. Income tax calculates tax on profit, VAT, and then Tax Procedures Act, which controls filing, audits, and enforcement. Tax education for you as a business owner is a foundation for success in longevity of your business. Subscribe for more content like this. Like and share to your friends. Thank you for watching.